Welcome back. The SEC is seeking a major rule change that could have hedge funds taking less risk. Our Leslie Picker, following the money for us, joins us as always. What's this all about, Leslie?
Hey, Scott. So it's seemingly a technical tweak, but one that lawyers say could fundamentally change how business in the private fund industry is conducted. Now, the rule change involves lowering the bar for fund managers' indemnification from gross negligence to ordinary negligence. The current standard allows limited partners to sue general partners only for recklessness or disregard to obvious risk. But if that were changed to ordinary negligence, then LPs may be able to sue for simpler mistakes, making it easier for them to bring claims against GPs. That may steer managers towards safer but less lucrative bets, says Mark Elovitz, chair of the regulatory practice at Schulte, Roth and Zabel, a law firm that counts a number of private funds as clients.
The ability for fund managers to take risks and to be protected for their simple day-to-day conduct is fundamental to having an investment strategy that has potentially higher rewards. And so if you're going to have funds that offer potentially higher returns, there are going to be risks associated with that. And investment managers are going to have a hard time protecting themselves from being on the hook for those risks.
SEC Chair Gary Gensler has said in the past that this proposal prohibits GPs from, quote, engaging in a number of activities that are contrary to the public interest and the protection of investors. This is the subject of our latest Delivering Alpha newsletter, out every other week. You can subscribe using the QR code that you see on your screen right there. Scott.
Thanks. Stay with us, too. Weiss, obviously, I'd love your opinion on this.
Yeah, so look, what they're targeting are the clauses in all the subscription documents that say, hey, you can sue us, but it's got to be gross negligence. So it really does change the standards. The language may be subtle, but the impact of it, as we just heard from Schulte, which is one of the top attorneys for formation attorneys for hedge funds. But it doesn't just affect the hedge funds.
But do you think, let's stop first before I get to the other part. Do you think the impact to hedge funds will be significant as a result of this?
I think what will be significant is that it's going to increase the costs of it. There'll be some bets that they don't take. It's going to increase the paper trail. It's much more bureaucracy. And if you expand it, it's not just hedge funds, it's also venture capital funds, private equity funds. The most who are at risk, in my view, are venture capital funds, and that has a direct impact on the economy because venture capital funds, they're looking for one winner out of every 10, 20, 30 losers. So they're going to have to, really think carefully about what they do. But this is ultimately going to be shaped by the courts. So the question is, if you really mess up on one position, but yet the overall portfolio performance is good, do you have a cause of action?
No, I'd love Leslie's take on that. I think that's a great question, right? Proving quote unquote ordinary negligence is not exactly easy either. No. I guess would be the question.
Yeah, it's much more of a gray area, and I think another element to this will be due diligence and kind of how you can stand up certain investments in court, and that kind of goes into the whole idea that managers will be far less risky if they, are doing, extra due diligence, which some would argue is actually very necessary in this world, but also being able to really, really justify any kind of loss that you have in your portfolio. It's much more of a gray area of how the courts will respond to that.
And it's also that you're going to hit the managers that can't afford the infrastructure. For some of the managers, that have made their money say, okay, that's it, the last straw, I'm getting out of the business. But who are you trying to protect?
Time to go family office.
Right, time to go family. But who are you protecting? They're sophisticated investors. There's a certain financial limit that net worth you need to invest. So spend your time enforcing so many of the laying down rules for so many other things and leave this alone. At some point, it's got to be buyer beware. It's self-policing, because if a manager screws up, they're out of business anyway. If they're not doing the due diligence repeatedly, and if there are what would be gross mistakes, then they're not going to stay around. So it's really formed to self-policing in the hedge fund world and private equity. Private equity, though, they've got 7-year, 10-year, sometimes 15-year investments.
You got a quick take on this? What we got?
I think it's the SEC just trying to expand the enforcement net further. And I'm not necessarily sure that it means that hedge funds are going to be taking any less risk.
They'll just paper it more.
Yeah, I think they'll just model things differently. I think when the opportunity to potentially generate alpha is there, they're going to take it.
The ambulance chasers are going to benefit so much from this. That's who's going to benefit.
Hey, Les, thank you so much. Great stuff. I appreciate it. Leslie Picker.